A Fed rate cut is on the cards, but how much will the market have to look forward to in 2026? Markets are on edge ahead of the Federal Reserve decision tomorrow. Traders see a 25 basis point cut as virtually certain, but the bar for the next rate cut could be higher. Fed funds futures markets see a total of about 77 basis points of easing by the end of 2026, so that's 2 more cuts next year, although bond investors are positioning for fewer. Paul Hollingsworth is head of developed markets economics at BNP Paribas 360. Paul, what sort of tone are you expecting Chair Powell to strike tomorrow?
Well, we do expect Chair Powell and the Fed to deliver the 25 basis point cut, but we think the overall tone will be a relatively hawkish cut. In other words, we expect that Powell will signal that the bar for further easing is now higher, and that this period of preemptive risk management cuts is now more or less come to a conclusion.
How much then do you expect rates to come down in the next year?
So we still expect one further cut in the first quarter of next year, and that's partly linked to the fact that we do think the economy will be going through a bit of a soft patch as we enter the first quarter, in part linked to the shutdown that, of course, has already happened. So we think that this will be temporary, but we think given the Fed is following, in our view, an imbalanced reaction function at the moment and very much placing weight on the downside risks to the labour market, we think if there is a bit of softness, that will prompt it to cut once more. But we think the bar for considerable further easing beyond that point is going to be pretty challenging because we do think it will be ultimately based on the economic data, and the fact that the Fed is now cutting into what we would consider accommodative territory for monetary policy, that should actually provide a floor for economic activity next year. So we think next year is going to be relatively resilient growth for the year as a whole and relatively elevated inflation, which doesn't justify further easing beyond that point.
There has been lots of market speculation in recent weeks about the name of the next Fed chair, but are you confident that outlook will remain similar whoever's named, or could a Trump appointee try to push for more cuts than seem justified?
Well, our base case is that Fed policy will ultimately be decided on the economic outlook and the incoming economic data rather than the specific Fed chair. And as I've already mentioned, our view is that the economy should be relatively resilient next year, and the inflation picture also looks relatively elevated. So we think that it's hard to justify, based on the macroeconomic fundamentals, considerable further easing next year. So the way that we would expect any changes at the Fed to manifest themselves is through continued dissent and public disagreements about the outlook for policy, rather than it affecting the central case for policy itself.
Well, next week we also have rate decisions from both the ECB and the Bank of England. Let's take the ECB first. Do you see the next move there as a hike?
Yes, our view is that the next move will be a hike from the ECB, although not for a while. We're expecting the hike to come in the second half of 2027. So really the story for next year is a prolonged policy hold. And that reflects the fact that headline inflation right now is close to target. We think it will go a little bit below target next year. And over time, the fiscal stimulus that we're seeing in Germany, we think is going to cause growth to accelerate. And we think underlying price pressures will also build. But again, that's probably more of a story as we move into 2027. And at that point, when the ECB sees inflation that is above target and core inflation that is also building, we think that will prompt it to raise interest rates.
What about the Bank of England, Paul? With inflation so persistently high here, how much space do they have to ease in 2026?
A key difference between the Bank of England and the ECB is that the ECB has already taken rates back to a neutral setting, whereas for the Bank of England, policy is still a little bit restrictive. So our view is that there is still some scope for the Bank of England to bring rates lower. We are expecting a cut in December, and we expect one further cut in the first quarter of next year. But we think that will leave policy slightly restrictive. And we expect the Bank of England to keep policy at that level for the rest of 2026 until it feels confident that some of the stickiness of inflation has started to ease. And then we would envisage another 2 cuts, so 50 basis points worth of cuts in the first half of 2027, once it is a bit more comfortable on the inflation outlook.
That was Paul Hollingsworth of BNP Paribas 360. Don't forget, you can watch more videos on Reuters.com.